3, 2, 1, and we're live. Hey friends, how you doing? It is Ernie with Asymmetric Options, 3D Options that is, and it is Wednesday. What is this? October 21st. We're getting along in those days, very close to the election. You would think that volatility in the market would start building, but it really hasn't. Even with the bombshell announcements that have been made or discoveries or whatever. I'm not going to get into the politics or anything, but just how that reflects on the market, it's surprising. In fact, volatility today has dropped. And so that's, you got to wonder what is actually controlling this market, what actually gets traders excited. If it isn't a geopolitical event, then what? Apple? Zoom? Netflix? I don't know. But today we're going to talk about calendar spreads. Now, calendar spreads are a very, very interesting way to trade the market. And the reason why, now first of all, let's back up a little bit and define what I'm actually talking about. We're talking about options contracts, standard American options contracts. And as you know, there are longs called calls. That's betting that the market will go up, and puts betting the market will go down, and they represent stock underneath. And it can be stock, it can be an ETF, it can be an index, it can even be a futures contract. But you trade these options. You can trade them individually as longs or calls. You can go, as calls or puts. You can also go long on one of those. In other words, buy an option, or you can sell it to somebody else, also called writing an option. Now, that's the uninteresting part about options. If you're just buying options, which most people are suggesting that you do as a way to just leverage buying or selling stock, then you're really missing out on the power of options, because there's more to an option than just directionality. You have direction, you have time, and you have volatility. All three of those three components, the three dimensions, hence the 3Ds of options, allow you to model your idea of what might be happening in the market. Not just model, but you can isolate various aspects of the market. You could isolate and create trades that are neutral to price direction, or have any degree of neutrality, so they can be slightly biased up or slightly biased down. You could set it up so it's slightly biased up, but then more biased when it goes further down. You can also isolate time, make time your only factor. You can isolate volatility, whether you think volatility is going to remain the same, go up or go down, or trending, whatever you want. This you cannot do just by buying a call or a put, or buying a stock or a future or a forex. You cannot do that. And that is the real power. Plus you have the leverage. Leverage is almost an afterthought. Sure, you have the leverage, and that's great. But the real power is in the ability to model. And the particular thing that we're going to talk about today, calendar spreads, has to do with buying and selling. It's a two-leg strategy. Buying and selling a contract of the exact same price and the same type. When I say type, I mean it's either a put or a call. So you're buying a put and selling a put, or at the same strike, or you're buying a call and selling a call at the same strike. Now, what is the theory behind all of this? The calendar, what is significant besides the fact that one expires one day, or a near-term strike, and another a near-term contract or expiration, and another expires later on, a further out expiration. What is the relationship between something that's close and further away? Well, if you're a student of the market, you're a student of, say, futures contracts, you know that all future dated contracts in the futures market are priced a little bit higher than the next. So for instance, if you were to look at an oil contract this month, it's priced at X. You look at the exact same contract and its price for next month's contract, it's priced a little bit higher. And then the next month after that, a little higher than that. And then next month after that, a little higher than that, and so on. The reason for this is that as you go further and further and further out into time, things become less known or less predictable. And when things are less predictable, we assign a greater degree of probability or randomness or volatility. So we price them higher. Greater risk, greater return. Now, when we price things out into the future, as a general rule, we tend to price them a little higher than what actually happens. So we might say that, hey, volatility in 3 months is going to have a range like this, right? Like that. And then what actually happens, it has a range like that. And we do that consistently, and the market just does that. Now, there's an interesting thing here. If you have two contracts of different expirations, one's further out than the other, they're going to be priced differently, just like a futures contract is priced differently, because the premium is going to be different in them. The actual underlying strike price won't be different, but the premium will be different because it will be valued more because it's further out into the future. So that is the basic premise behind a calendar, is that you're not really playing with price. You're kind of playing with time. You're not playing with directionality that much. In fact, you'd like price to sort of stay within a range. You're playing with that difference in time. And as one contract approaches its expiration, how do the relative prices of those two contracts change relative to time? That is what a calendar is about. All right, so I got a little presentation to go over that. I just told you what it's about. Now I'm going to tell you again, and then I'm going to tell you what I just told you. There we go. Let's swing over to the chart, to the other monitor. Yep. Let's start at the beginning. How a calendar spread works. Let's see, we also have to make sure that the chat is going here. I know there are people online, but they haven't really said anything yet. If you have questions, just put it in the chat. All right, so what is a long calendar spread? So when I say long, a long calendar spread is when you buy a calendar spread, and that assumes that you're selling the near month and you're buying the long month or the further away month. It's a two-legged option strategy of the same type. As I said before, either they're both calls or they're both puts at the same strike price. So both of them, let's say you did it on the SPY today and it was at 347. Both the short put would be 347 and the long put would also be 347. They would just have different expirations. One might expire this month, the other one might expire next month. So there are two different contracts. You sell or write the near expiration contract, or you buy or go long on the far expiration contract. That is considered buying or going long on a calendar spread. Now, this is sometimes also referred to as a horizontal spread, as opposed to something that you're probably more familiar with, and that's the vertical spread, and which is also a two-legged spread, a two-legged options strategy of the same type, either a put or a call. But the vertical spread differs in that it has different strikes with the same expiration, where a calendar spread has the same strike but different expirations. And you can kind of visualize that like this. If we had a chart here of these contracts that are writing, where the x-axis here is the days to expiration, and then the y-axis is the strike, a vertical spread, which you're probably most familiar with, has a short at one strike, you know, and maybe at a lower strike, and a long at a higher strike, as opposed to a horizontal spread. And now you can see the way we're doing horizontal in terms of strike, I guess. A horizontal spread will have the short that expires before the long contract expires. I don't know if that helps. Just another visualization. So here's an example. We'll have a way to notate a long calendar spread. It's a long calendar of SPY with two different expirations, the 20th of October and the 23rd of October. All right, so there's an example. And they're both have a strike of a 343, and they're both puts. So individually, these legs would look like this. You'd have a short leg, SPY, 20 October, 343, short 343 put, and let's say it costs $2.35 to put that, to buy that or sell that put. The long leg, here it is, it's a different expiration, and it's the same strike, but this time it's long, a put, and this one might cost $2.99. Now, the way you price the calendar spread is you take the long and you subtract the short. And so this calendar spread there would be a 63-cent debit. All right, 63-cent debit. And if you had Thinkorswim or you had your profit and loss chart diagram, your risk diagram, it would be plotted like this, where the max loss is the cost of the debit, the cost of the calendar spread, the debit that you paid for it. And then the max profit, well, the max profit's a little bit more difficult to determine because the max profit really depends on the amount of volatility in the market at that time. And so that can actually change. So if you have a lot of volatility, that max profit could go way, way up. If you have a less volatility, because that will determine the overall moneyness of the contract, then it can go down. And then, of course, the purple line here, if you're familiar with Thinkorswim, is your actual T0 price of the contract. So today, right now, that's where that purple line is. If I opened this up right now, that's where it would be. And as you can see down below, it's the same contract that I created this morning. All right, let's. So here's the options chain, and I wanted to show you on the right-hand side. It's showing you the implied volatility for each one of these expiration dates for these contracts. All right. And you can see that the near-dated ones have lower implied volatility, and as you go further and further out, the volatility increases. Now, you're not seeing a huge increase here because we have such fine granularity with the SPY. We have 3 different expiring contracts per week. But if you just saw monthlies, you would see a big difference between top and bottom, and maybe we can demonstrate that. And look at the options chain of, say, I don't know. Let's look at the options chain for Netflix. Let's do something. I don't know. All right. So here's a bunch of monthlies, and you can see how. Let's see. That's not a good example because they're going through something. Let's see. What's a good example? Let's try Ford. As you go further, boy, Ford has a lot of volatility in it. But anyways, as you go further and further out, the prices get higher and higher. or the volatility gets higher and higher. You can see that here as well. But that difference is significant. And this is the reason why it's significant, because this is really the crux of how a calendar works. So this is showing you the expiration or decay curve of any individual contract that's out there, and the amount of premium that's in it as you get further or closer to the day of expiration. So the curve itself represents the amount of time-based premium in it, and as you get closer and closer to expiration, that diminishes at an exponential rate. And so the amount that it diminishes, say, between 30 and 60, I'm sorry, between 0 and 30 is great compared to between 60 and 30. Now imagine if you had two different contracts, one that is expiring in 30 days and one that's expiring at 60 days, and they're both in this spread. Well, the premium that's between those two is going to grow. The difference is going to grow as you get closer and closer to expiration, because the short or the near-term contract is going to be decaying much faster, at a much faster rate. And that's actually what you're banking on. That's what you're making money on, that change, that rate of change. Now, there are things that can affect that. And one of them is, as I had mentioned earlier, was the amount of volatility that's currently in the market. And it can kind of skew that. But in general, that is what you're playing on. So you put one of these trades on, and as long as price stays somewhere inside that profit tent, that area, as time goes on, you'll start decaying. The short strike will start decaying, and the price of that overall option, remember, is the long strike minus the short strike. So as that short strike is decaying faster than the long strike, the overall price of the option is increasing. And that, in a nutshell, is how you make money. And I can kind of demonstrate this too. Well, let's see. How can I demonstrate this? I will go and look at SPY. And what we can do is we can advance the time. And this is a sort of a simulation. In the lower right-hand corner, I can change the date. We're currently at October. And if I advance time, you see how it, see that? The purple line, it grows as time advances. And so the value of that's the value of the contract getting more and more rich as time goes on, as the difference between the near-term contract is decaying faster than the long-term contract. And so that is where you're making money. I know it sounds weird. They're both decaying, but one's decaying faster than the other. And the price is ultimately determined by that difference. And that's how you make money. And you don't make just a little bit of money. In this particular spread here, this is a very, very tight spread between the expiring contract for this Friday. That's the short contract I took. And the long contract is the expiring contract next Monday. So it's only less than a week out. Yet, when I first put this on, say today, it cost me it cost me 63 cents. Well, right now it's priced at 65 cents. In 2 days, it'll be worth, if I stay right at the same price, it'll be worth $7.60. That's quite a difference. I'm sorry. Yeah. No, it'd be worth 75 cents. Is that right? It would be worth 75 cents more than what I paid for it. But it'd be worth a lot more, is the point. So for just 2 days worth of work, and as long as SPY doesn't go outside of these boundaries, which are fairly wide. The break even is as low as 336 on the bottom side, and on the top side 349. So you've got a 15-point swing in 2 days. This gray area would represent 1 standard deviation of a move. So within 1 standard deviation, the likelihood of you staying within there is pretty high. And you're not going to hold it to expiration anyways. We're only holding it until the first leg expires. And or maybe even on Thursday instead of Friday. Maybe we just hold it to Thursday. Now, if it happens to land right in the middle on Thursday, we might want to take a chance for Friday and see what happens. Because if Friday also hangs out right in the middle of this tent, we could max out our profit. And for something that cost us just $63 to put on, we could end up making $150 in profit. All right, back to the big head. And looks like we have some questions. Are calendars better than vertical spreads? They're really used for 2 different purposes. A calendar, in general, is better when you have relatively low volatility and or you expect volatility to rise. Because as I said before, the overall value of a calendar can increase dramatically with a rise in volatility. And let me demonstrate that. So I can do something else here. I can increase the amount of volatility that might be in the market. I can simulate that with this volatility adjustment. Now watch what happens to the overall curve as I increase volatility. It's growing. Now I'm going to add, let's say, up to 5% more volatility. There's 5% right there. The overall curve now, the max value of this at 5% more volatility is a little over 200. It's at 224. Now let's look at what that would have been at 0, or at whatever it is now. This is plus 5% for whatever the volatility is now. And we'll bring it back to present day. Now the max profitability is 158. So it increased, the whole overall value of that contract increased by $70 just by going up 5% in volatility. Now you can actually measure that and see the rate by looking at the Greeks. You can look at Vega, and it will tell you that rate, that it's either increasing or decreasing. So the calendar spread is good for lower volatility environments, or environments where you think volatility is going to rise while you're holding that those contracts, that spread. A vertical spread, particularly a credit spread, works best in the opposite direction, where volatility is staying the same or you expect it to drop. So after you have a big spike in the market, you would expect volatility to start dropping and then degrade over a long period of time. That's the best time to put on credit spreads. When you're down near the bottom and volatility is leveled off, that's the best time to put on calendar spreads, like now. Now, that's not the only time you can put it on, but I'm just saying that's your optimal time. So Robert's asking, what do you look for to take profit? You look at that purple line. When that purple line goes up, that means you're making money. Or do you aim to let them expire worthless? No. In general, you have 2 different expirations, so it's hard to make both of them expire worthless. That's just not going to happen. So generally, you're going to take this off before, or if it gets threatened, if there's a risk of being assigned stock, if you don't want that stock, that may be another reason to get out of it. or if price moves outside of that profit tent and it's no longer profitable for you, that may also be a time for you to get out. So when the first leg expires, you would manually close the back leg. Yes, maybe. If you want to keep on rolling, you might be able to go and then short. Well, yeah, you would have to roll both. That would be one option. Maybe you just roll it to the next period or the next set of periods. So if you have built up some profit, then it's a kind of a free ride. You can just roll it to the next set of expirations. That's probably the best way to do it. So what I'm demonstrating here in the screenshots that I've shown is a really short-term one. Most people are using calendars in longer term. I intend to use these for very, very short-term intra-week spreads and collect a lot of money very quickly with very little risk. And the risk on these is extremely low. The risk on this particular one is just 63 cents. When I have the ability to more than double, so it's like a 1 to 2 or even a 1 to 3 risk to reward. Any more questions? If not, then I'm going to stop it here and say that's about it. Other than let's go to this. If you would like to learn more about how to actually trade these, learn our strategies around them, then I suggest going to asymmetricadvisor.com. I also have some entry-level type services, alert services, where we use Robinhood and take advantage of the no commission platform, where I can show you how to grow a very small account and double or triple its size very quickly. And then once you've graduated from that, if you want to then join our community where we're building portfolios and building wealth using these kind of strategies, then you can join that. What amount of capital for risk? Well, that's what I just said. You can risk $63 to realistically make $100 or $120. I think that's realistic. And I would say with a fairly high degree of probability, probably in the 70 to 80% range. Now you could expand that. Actually, you could increase your ability to make profit through the use of something called a double calendar. That's where you have two calendars on, and that is a situation where you could reuse the further outdated one, or the right side or the left side, and just keep on rolling these, and expand your profitability tent, your risk tent, to a significant amount, and then add more contracts, and there are a lot of options, no pun intended. All right. Just one more reminder here. First of all, give this video a thumbs up if you like the content, and leave a comment below if you would. To become a member, go to asymmetricadvisor.com. We offer education. When I say education, I'm talking about live coaching and mentoring. Alerts, which are our live account. A community of traders. We have hundreds of traders there. You'll learn our strategies, and we do everything in the context of a campaign. It's a continuous improvement process. So to answer your question, the answer is yes, Robert. It would, you could add contracts. There are other ways that you can increase the overall reward risk reward too, besides just adding contracts too. You can go to longer dated, but this is going to be focused on short dated things. This is an income producing strategy that I'm building up to. So, but I'm just using this as an example. We have every Saturday we have webinars, and we also have weekly classes in our community. It's a Discord community with private channels. All my trades are taken from my actual live account, my live money account, both in Robinhood and in Thinkorswim. The trades and the transaction logs are posted in real time, as well as the brokerage statements. I distribute that to all of our members every month, and they see, there's no getting around this. I'm showing my real P&L. So there's nothing fake about this, like most of the other services that are out there. I would say 99% of the services out there are fake, because they are fake because they don't show you their real P&L. They don't show you their actual trading account. If they're showing you an MT4 account, guaranteed it's fake, because you can modify that. So anyways, that's what we offer for an incredibly competitive, I would say just downright cheap price. Join now. You won't regret it. Go Google Asymmetric Advisor, the 2 words, and read some of the reviews. Just a fantastic service. You won't regret it. All right. Seeing that there are no more questions, I want to thank everybody for joining me, and we'll see you next video.